Mobil out with third quarter results this morning, and joining us right now to talk about it is Darren Woods. He's Mobil's chairman and CEO. And Darren, welcome. It's really great to have you here today.
Thank you, Becky. Good to see you again.
Good to see you, too. Let's talk a little bit about the numbers. You guys beat on the bottom line, adjusted earnings per share, $1.88 versus the consensus of $1.82. Revenue looked like it was a little short of Wall Street's call, at least according to some analyst expectations, 85.3 versus 86.5. How would you characterize the quarter?
I'd say it's a very, very strong quarter. In fact, if you go back in time and look at all the quarters since we merged with Exxon and Mobil merged, in the similar price environment, this is the highest earnings per share we've ever delivered, and reflects a lot of the hard work we've been doing since 2019. We continue to reduce cost. This year, I expect we'll have another $2.5 billion of cost reductions. If you go back to 2019, that's a cumulative cost reduction of over $14 billion. Nobody in our industry, in fact, if you take all of our industry competitors and add them together, we're still out competing them on cost reductions. And then we're growing the top line. If you look at our production coming out of the Permian, it's at record levels, coming out of Guyana at record levels. So I think a very, very strong quarter in a mixed price environment. And importantly, we're laying the foundation for the growth out to 2030. Our plans today will grow earnings by $20 billion through 2030 and cash flow by $30 billion. And a really critical part of that are these enormous mega projects that we have to bring on. This year, we had to deliver 10 projects, advantage projects that are going to form the foundation for this growth. We're through 8 of those so far, and we've delivered all those consistent with our plans, on or ahead of schedule, on or ahead of budget. Frankly, nobody else in our industry has had that kind of track record.
Yeah, I looked at the results and I thought they were pretty good too, which surprised me to see the street trading the stock off by 1.6%. I've been digging around trying to figure out why you'd see a sell-off. Maybe you can enlighten us with what you think. The only thing I could come up with was something from Barron's where they just point out that Mobil is growing production at a time of potentially falling oil prices. Historically, that's led to problems in the past with some of these companies, with some companies. What's your explanation of what the street's instant reaction is to this, Darren?
Well, I think at any moment in time, what we've seen here, I suspect today, and what we've seen here in the last several weeks and months, frankly, is just the uncertainty in the market, where the supply and demand balances are going to land with respect, and people taking bets as to what they think is going to happen going forward. Frankly, we don't spend a lot of time worrying about or trying to predict what short-term prices are going to do. We stay very focused on the long term. And frankly, if you look at the work we've been doing to drive our costs down and drive production down, our profitability on a barrel of oil has more than doubled since 2019 on a constant price basis. And from a break-even standpoint, our cost of production is very, very low. And so even today, at today's prices, we feel really good about the economics, the returns that we're generating, the plans that we lay out going forward in the future. The prices are very consistent with what we've seen here. And in fact, we're resilient much, much further down in the price deck. So we feel good about the returns that we're generating. I think if you compare other companies, they don't have the same, I think, break-even costs that we do. And so they may be more challenged in these environments, but we're still generating very, very strong returns.
What is your break-even cost?
All the projects that we're investing in have to generate a double-digit returns at $35 a barrel.
Wow. And that's for your portfolio right now, or the portfolio as you see it 5 years from now, 10 years from now?
The investments that, as you know, Becky, we've been making investments, probably investing at a higher rate than our competitors. And the criteria that we've set for ourselves for our investments in the upstream and, frankly, across all of our businesses is we have to be at the low end of the cost of supply curve. In these commodity markets where the market supply and the market demand sets the price, we're basically price takers. Our job is to be at the far left-hand side of the cost of supply curve. So whoever's out there setting that last barrel price, that we have a healthy margin. And so all the projects we've been investing in since, frankly, I've been in this job have been driven by this very low cost of supply. That's the hurdle that our businesses have to get over in generating these projects. And it's why we put so much emphasis on technology. If you don't have a technology advantage, you can't bring the scale, you can't bring the best thinking of your organization to develop innovative advantage projects, then we won't have a long-term future. And frankly, all the work we've been doing is enhancing those capabilities, and that's manifesting itself in very advantaged projects.
Hey, Darren, we don't have a lot of data points from the government, obviously, because they've been shut down. We've been trying to do our best to kind of get a feel for what the jobs market, other areas look like from the CEOs we talked to. You all did announce last month that you were going to have layoffs of about 2,000 people. This was a restructuring in the EU and in Canada, I believe. Maybe this fits into what you're talking about with trying to make sure you're in the right places with the right projects. But from the jobs perspective, how do you see the environment right now? What's Exxon doing?
So with respect to the announcement, you know, the work we've been doing since 2019 has really been focused on transforming how we work, becoming much more effective and more efficient at the same time. This last announcement was more of a focus on where we work. So as we've changed our work processes, drive our teams to be more innovative, increase the teamwork, the footprint that we were in is frankly decades old, and so we are shifting our footprint consistent with now how we work, and so that has an impact broadly around the U.S. Those reductions are about 3 to 4% of our global workforce. So they're not driven by cost cutting; they're driven by effectiveness. And of course, with that comes some efficiency. There are no impacts here in the U.S. We had made those changes already by consolidating all of our offices down to the campus that we have in Houston. With respect to the broader market, frankly, if you look at demand for our businesses, demand remains very, very healthy with growing economies, continued growth in economies all around the world. And our ability to attract employees from the wage level all the way into professionals, we're not seeing any challenges with respect to that. So things look pretty good right now for the business in terms of how we're running it. Big challenge in the marketplace and what's driving that commodity cycle is the amount of supply that's coming onto the market, frankly.